Saturday, May 3rd, 2025. Hope you're all having a wonderful weekend. Before we dive on into this, do me a favor and hit up the like button, subscribe to the channel, share this video with a friend, and all of the above. All right, let's go ahead and dive on in. I have two charts from this account here, Cena 21st Capital. I'm telling you guys, this might be the most underrated account on X. I am loving everything that I see from him. And I already talked about this chart, but I want to just expound on it again. So Bitcoin has historically grown 6x with every 40% increase in its age. It's not about the calendar year. It's about age. So every 40% increase, do you understand this? Do I need to explain this? But I'm going to anyway. Every 40% increase in its age. For example, let's say there was a year between $1.05 Bitcoin and $7.10 Bitcoin. So then the next 6x, it would take about 40% as long. So a year plus 40%, that would put us, a year and 5 months or so. Within that year and 5 months, Bitcoin did a 6x. And then same deal, add 40% to that. That's where I'm going to begin to fail. Within that year, when that 40% plus the year and 5 months, that brings us to another 6x. Same deal, 40%, increase 40%, increase 40%. And where were we? 59,000.16K. That was in late 2024. That's actually mid 2024. And so this would put us a 6x above 69K, is 6x times $360,000 or so in around 2030. So that's just really fascinating to look at. I love everything about this. It explains diminishing returns, but in a way that has personally me excited, and I hope that would excite you too. Now, does that mean that this is going to remain constant like this forever? There's no guarantees, but as a believer in Bitcoin eventually being infinity in terms of the dollar, it tends to make sense that we would follow some kind of a trajectory like this until we see some kind of a break to the upside or the downside, more likely the upside if Bitcoin equals infinity. Another chart from Cena 21st, the anatomy of a V-shaped recovery. That's not what he calls it, but the V-shaped market. I finally got around to explaining my entire 2025 playbook. Bookmark this and mark my words. I'll go ahead and bookmark that. So we have the V-shaped market playbook. We have tariffs, psychological shock, tariffs, inflationary shock, liberation day, uncertainty over, tariffs, recessionary shock and disinflation. Spending cuts won't be substantial. And then the V-shaped recovery. What do we see? Fed and inflation tamed and rate cuts resume. Yeah, that'll probably come in June or July. Then sideline money flows back in. Hedge funds, money market funds, international investors, cheaper energy, more growth, less inflation, administration tax cuts, administration deregulation. I am on board with this playbook. Absolutely. A lot of you consider me a bear, but just the opinion that I hold, that I'm going to continue to hold, is that this V-shaped recovery eventually leads us lower before it leads us higher. I mean, could we hit a new all-time high between now and the eventual bottom? Sure. And then, you want to talk about this for 2026, 2027. I am all on board. But guys, I'm not a bear. I'm a mega bull on Bitcoin. It's just a matter of having all of these things line up. So let's look at not that Cena is at all saying this, but let's see what he has to say here. The core of my thesis has been that Trump's policies are overall very bullish, okay, with bearish components happening first. Similar to Reagan, when Reagan started out his term, you see a lot of red and yellow to the left of the image, and then a lot of green to the right, correct? Next post here, many were quick to compare Trump's tariffs 2.0 with a 1.0 version from 2018 and thinking that won't matter much for inflation and markets. I've been maintaining that they will crash the markets and raise prices. Number 4, inflation data started going up right after Trump was elected. Tariff front running has also been pushing prices up ever since. Number 5, based on this analysis, I expected the current crash and warned about it ample times up to February 1st, right before it actually happened. We had gotten all the components, the inflationary signs, less dovish Fed, a sizable crash in Bitcoin and other markets. I then followed the market for signs of recovery. Markets were in total panic, but on March 10th, it happened. I got the first signs and deployed capital. We got a sizable bounce after that, and that got me to the second phase of the thesis. This was the time to be paying full attention. As we approach the Liberation Day tomorrow, that was a tweet from a while ago. A lot of bad news is already priced in. Let's go back to here. The inflationary shock from tariffs is self-healing and will be short-lived. Instead, it will renew recession fears. We are definitely now seeing some signs of this fears that I have, but this is actually not as bearish in my book because it will coincide with most of the bad news being priced in and the Fed turning dovish again. Eventually, yes. As this all unfolds and recession fears pick up, Trump will have achieved several goals. 1, disinflation. 2, trade war waged, some concessions secured and heavily marketed. 3, 10-year yield down. Let's hope that that's what happens. And Treasury debt refinancing successful and mortgage rate down. Meanwhile, the Fed will be resuming cuts as inflation won't block them anymore. I'm going to stop here. Really neat thread from this guy. I'm telling you guys, please give him a follow. I love everything that he posts. I'm sure he puts a lot of effort into his content. And so, moving on. Michael Saylor, by the time your financial advisor says it's okay to buy Bitcoin, it will cost $1 million. When they say it's a good idea, it'll be $10 million. Bitcoin ETF exposure access across top wealth platforms. Really interesting thing. I have a couple friends who are financial advisors. And about a year ago, I asked them if there was any possibility for me as a content creator to become a financial advisor in a way that couldn't compromise my content. And the answer was, enthusiastically, they wanted me to pursue becoming a financial advisor, but the compromising of the content, I would have to submit things for approval and everything like that. That's why you see very few financial advisors making content or having their own channels because of things for approval. And I was like, no, not interested. But then I talked to one of my financial advisor friends recently, and he told me that his firm, at least, is very much warming up to Bitcoin. We're not there yet, but there may be a possibility for me to actually be a financial advisor and still talk about Bitcoin. Now, like random meme coins, probably going to have to throw that away, and I'm not going to cry. But Bitcoin and whatever else, other cryptos, at least cryptos that get ETFs, let's do it. So, biggest goal of my lifetime, ETF one day. I'm being a little facetious when I say that, but a man can dream, right? So anyway, this chart. Here's what we have here. Only 5 of these platforms allow unrestricted exposure to Bitcoin. Charles Schwab, Fidelity, Wells Fargo, and Mariner, and Fisher Investments. And then some have exposure restrictions, including Morgan Stanley, which is actually surprising to me because Morgan Stanley owns a lot of MicroStrategy. I remember in 2021, they owned 10.9% of every MicroStrategy share. So interesting. Bank of America, I'm not going to read all of them, but then there's some that still have entire prohibitions, including Vanguard, Edward Jones, Raymond James, Citi, T. Rowe Price, et cetera, et cetera. So we're not there yet. But by the time that every one of these have unrestricted exposure to crypto, to Bitcoin at least, then it's going to be too late. So $1 million Bitcoin, $10 million Bitcoin. So now's the time. Now's the time still to be getting in. We are still early. Believe it or not, we are still early. All right, moving on. So that's it for Bitcoin related stuff. Now economic related stuff. And I'm sorry to say, I do have some bearish things which would support. All right, listen. Again, I am all on board with this perspective from Cena here, the V-shaped recovery. But also, I'm still saying that I think it's going to take some time to play itself out and that this wouldn't be a 2025 recovery. I hope I'm wrong. Please let me be wrong. But holdings of U.S. Treasury securities as of January 2025, we have Japan with $1 trillion, China with $761 billion, UK with $740 billion, Luxembourg, number 4, with $410 billion. What's the point of all of these? And then all others, 1.591 billion, so 1.5 trillion combined. So For decades, the Chinese and Japanese produced more than they consumed and saved the difference. As part of those savings got invested in the U.S. treasuries, which meant the U.S. government could spend more than it earned and borrow the difference. The more Asian savings grew, the more U.S. borrowing surged. Western economists understood this mechanism, but instead of thanking the Asians, this is an Asian guy, isn't it? Yeah, maybe. Looks like an Asian guy. I'm going to give him a follow anyway. So, good post. Instead of... Listen, he's right. He's not wrong. All right, let me get back to where I was. The more Asian saving grew, the more U.S. borrowing surged. Western economists understood this mechanism, but instead of thanking the Asians, they vilified them for saving money. They called it the savings glut. As Asians grow older, they start dipping into their savings. They sell U.S. assets at an accelerated pace because the dollar is in decline, and the current administration says they are no longer welcome in the U.S. market. Western economists understand what's happening, but instead of rolling out the red carpet to stop the exodus, they vilify Asians yet again by saying they are taking advantage of U.S. consumers. China pegged its currency to the dollar. This is a really, really good point. Okay. China pegged its currency to the dollar in 1994, a move applauded by Western economists at the rate of 1 USD for 8.28 Chinese yen. Today, the dollar buys 7.26 Chinese yen, which means, yuan, excuse me, which means the yuan has appreciated 14% in the last 30 years. Okay, and yet Western economists and media personalities like Kyle Bass keep belittling the Chinese for devaluing the currency to boost exports. A lie repeated often becomes conventional wisdom. Now the U.S. government faces massive budget deficits, a starkly divided Congress, interest payments going parabolic, and $9 trillion worth of debt refinancing. We go back and forth sometimes. There's back and forth, different perspectives with tweets, with opinions as to who's going to win this trade war. As an Austrian economist, it would make sense to me that the ones saving, not necessarily that they're going to win the trade war, but that they have the upper hand. That just seems to make sense. Maybe I'm wrong. Maybe I'm crazy. Here's the federal government current expenditures in terms of interest payments alone. Hey, look at that. Let's celebrate a little bit of a downturn in interest payments. But man, this is going parabolic. And how do we combat this if Asian countries are dumping their T-bills and not accumulating them anymore? Well, I've mentioned multiple ways to do that, and one of them involves pretty heavy inflation, lots of money printing, lots of treasury buybacks, things like that. We'll see. But I tend to think that our Asian friends across the Pacific Ocean have the upper hand right now. Moving on, U.S. GDP. Some positive news here. Hey, some positive stuff, okay? And this is actually making me wonder if my entire thesis is correct. In terms of entering a recession at the end of the year, we're going to have to wait until 3 months from now when we get the next GDP report to see if we are actually in a recession. But the fact that GDP came back negative 0.3% instead of negative 2.4%, which is what the Atlanta Fed was projecting, that actually got me kind of excited. Because, all right, what could explain that? Well, here's a tweet from Daniel Lacal. I'm sorry if I mispronounced your name. U.S. GDP. Yes, the private sector is strengthening and government spending is falling. All this is undeniably positive. That sounds great. The sum of consumer spending and gross private fixed investment accelerates in the first quarter. Investment soars. Imports rise is logical and reverse in the next quarters. And so what has contributed to the fact that we got a negative 0.3% report? Government spending is falling. I'll take that. Okay, you want to call that a recession? Then by all means, give me a recession. Government consumption and expenditures, gross investment, negative 1.4. When all these other quarters, look at Q4 2024, 3.1, Q3 2024, 5.1, 3.1, Q2. So Biden was spending a lot, essentially. Now, in 2021, not so much. Now, should I blame it on Biden? Trump would blame it on Biden. I'm not going to be one to do such a thing. But, hey, we're negative, and yet gross private domestic investment, my goodness, that's very high, 21.9 in comparison to Q4 2024, negative 5. All right, according to this, hey, let's keep this party going. this seems like we're moving in the right direction. At least the Australian economist in me is saying that. Now, TXMC, I love his stuff. And a lot of you, I'm going to tell you right now, you would not like him. And that's a you thing and not a him thing. But he gives a positive comment here. The negative print is almost entirely due to tariff front-running and gold imports. All in all, not bad considering the first quarter was absolute chaos. From a policy perspective, maybe Cena's got a point here. Maybe he's got a point here. I pray that I'm wrong and most others are right. But, well, we're not going to be entirely bullish on this video, I'm sorry to say. The great Martise, he's very bearish. Eventually. Not quite yet, but he's posted some pretty bearish stuff. And, stagflation looks about right. That's all he's saying here. From a chart from Wall Street Mojo, we have inflation rising, which, Cena does make an argument again that that inflation rising is going to come down. We'll see. Low GDP, that's for sure what's happening right now, at least. Recession in most economic activities, check. Poor implementation of government policies, check. I'm sorry. Listen, I would still vote for Trump. There's a lot of things about what life would be like about if Kamala Harris were president right now that I would not be a fan of, that really have nothing to do with the stock market. But there's no denying that this is kind of not going as well as Trump. If you could put him, give him some truth serum, it's kind of not going as well as I would think he imagined it, but we'll see. Higher rate of unemployment, ? We had the unemployment report yesterday. I'll be honest with you, I'm making this video before the unemployment report came out, just trying to get my bases covered for the weekend. And so I don't know what that looks like. Hopefully it's not terrible. And but it does look like, unemployment is climbing. So we'll see what happens. I did see a graphic or some information that UPS is laying off 20,000 employees. It makes sense given the fact that there's a lot less shipments coming from China. So let's see. Moving on. This isn't exciting. So, all right, Dow Jones, 1929 to 1932 bear market. Do I think we're going to repeat 1929 to 1932? Not in terms of dollars, but in terms of gold. And you can see even in the bear market, 1929 to 1932, there was a 48% rise, 15% rise, 23% rise, 26% rise, 34% rise, 25% rise. And then we bottomed out in 1932. I say we as if I was alive at that time. Guess what? I was not alive at that time. But, okay, Parallel Systems Broadcast says, this ain't going to be a recession, nor will it be a deflationary depression. Try an inflationary depression. So what does this look like? Instead of it priced in dollars, this would be priced in gold. This is a scenario where gold goes to $10,000 an ounce, where gasoline in the United States, gasoline is about $3 a gallon right now. It would go up to like $10 a gallon, something like that. So collapsing inventories, collapsing stock market, collapsing salaries, soaring prices. That sounds terrible, but that may be what's down the road. Hopefully we have a bullish end to 2025 or a bullish 2026, 2027. My friend Devin says that your boy Ski says that 2029 is when the S is going to hit the F. I don't know why I said F. It's fan, so we'll see about this. I do think that something like this is coming. I just don't know entirely the timeline. I would think sooner rather than later. I would think not 2029, but you got to be prepared, guys. I do think at some point it's going to get pretty ugly. What was this supposed to be? I don't know. Let's move on to the next one. Okay. Tomorrow, being not today, the day you're watching this video, will be day 8 in a row higher, which has tied a record going back 2 decades. We are now officially in the glue sniffing stage of the rally. This is the S&P 500. What do we make of this? There's probably some resistance ahead short term. We'll see where we can go. But probably some resistance ahead short term for the S&P 500. I've talked about the 200-day moving average being a key level, and it still is. And so if we can break through there, then maybe we will be blessed with a repeat of 1998, where in 1998 something similar happened in the stock market, and then we rallied to a blow-off top, and then it was over. So we got another year and a half, something like that. That would be the best case scenario for sure. But we'll see. We will see. This is compelling here. Let's hope that this is how it plays itself out, that we will have an opportunity to make some great gains short term. I'm a little skeptical for now, but I'm waiting for confirmation or a disproving of what I believe to be the case. But at some point, I think things are going to be, that this will play itself out. So anyway, have a great weekend, everybody. That's all I have for today. I hope you have a wonderful day, wonderful rest of your week, and I will most certainly be seeing you in another video. Peace.